welcome to the deep dive.
Yeah.
The tech world, I mean, especially with AI and generative AI, it's just moving at such a whirlwind pace, constantly reshaping industries. And, understanding these shifts means looking beyond just the headlines, really delving into the numbers and strategies of the key players. So today, we're embarking on a deep dive into the recent Q1 FY26 results for HCL Tech.
Right. And our mission for you today is really to walk through the various facets of HCL Tech's performance, from their financial figures right through to their strategic investments.
Okay.
We'll unpack each key development from these Q1 results, highlighting the most important insights to give you a clear, comprehensive understanding of where the company stands right now.
Okay, let's unpack this then. Based on the recent Q1 results for HCL Tech, the core message seems to be something like short-term pain for long-term gain.
Right.
What's the big picture here? What does that really mean for HCL Tech?
Well, what's fascinating here, I think, is how HCL Tech's Q1 FY26 really reflects this strong sense of urgency to reorient their business.
Right.
The technology sector is undergoing, you could almost call it a tectonic shift, right? With AI and generative AI challenging those traditional models.
Yeah.
So HCL Tech is clearly making some serious investments to make sure they're ready for this new AI-driven landscape.
So, okay, they're making these investments, but how did the top-line revenue actually fare in this quarter?
The revenue performance was actually quite satisfactory, even slightly ahead of expectations, which is interesting.
Oh,
It indicates there hasn't been a significant deterioration, in the operating environment for their core business. So that's a good sign.
But I did notice there was a hit to their margins. Why did profitability take a dip then?
Yeah, the margins mainly corrected on account of, lower utilization, meaning fewer of their people were actively billing hours on client projects. And crucially, significant investments in the future. This really points to HCL Tech actively pivoting its business delivery model. And, those investments come with upfront costs.
Makes sense. And what about order inflows? That's always a key indicator of future business. Any surprises there?
Order inflows were softer in Q1 compared to previous quarters.
Right.
However, this was largely due to the spillover of certain large orders into Q2.
Okay. So timing.
Exactly. So it's less a red flag about a lack of new business and maybe more just a timing issue for when those deals are officially recorded on the books.
Got it. Given these dynamics, what's their strategy for talent, for their workforce?
Well, they're focusing on Exactly. I think you've hit the nail on the head. The expectation is that the company is likely to come out stronger after this current phase of investment, despite what might be a relatively dull FY26 in terms of the immediate financial metrics.
Right.
And this outlook is reflected in their updated guidance, too. They actually upped the lower end of their full-year revenue guidance.
Oh, interesting.
But at the same time, they lowered their margin guidance to account for these ongoing investments.
Okay, that makes sense. Let's dive into the specifics then, the financial performance. How did HCL Tech's Q1 FY26 actually stack up against, say, the previous quarter and the same quarter last year?
Yeah, if we connect this back to that bigger strategy picture, the detailed numbers, based on the recent Q1 results for HCL Tech, they show a fascinating interplay. Quarter over quarter, so from Q4 FY25 to Q1 FY26, revenue saw a slight increase.
Okay.
From rupees 30,246 crore, which is roughly $3.5 billion, to rupees 30,349 crore, around $3.5 billion.
Okay, so sequential revenue growth, that's positive on the top line. But what about profitability? You mentioned the margin hit earlier.
Right, this brings up a critical point because while revenue did grow slightly, profitability metrics definitely experienced a decline. Gross profit decreased from rupees 10,504 crore down to rupees 10,221 crore.
Okay.
EBITDA, that's earnings before interest, taxes, depreciation, and amortization, which gives us a good sense of their core operational profitability that fell from rupees 6,482 crore to rupees 6,035 crore.
Right.
And their EBIT, or operating profit, also saw a drop. It went from rupees 5,442 crore down to rupees 4,942 crore, with the EBIT margin decreasing from 18.0% down to 16.3%.
And their net income, the bottom line.
Profit after tax, or PAT, their net income. Yeah, that declined to rupees 3,844 crore in Q1 FY26. That's down from rupees 4,307 crore in Q4 FY25. So it clearly indicates a margin miss despite that slight revenue beat.
Okay. Now let's look at the year-over-year comparison. So Q1 FY25 versus this recent Q1 FY26. How do those figures compare?
Okay, year over year. Here, the revenue actually showed significant growth. It increased from rupees 28,057 crore up to rupees 30,349 crore.
That's a decent jump.
It is. And in dollar terms, that's from $3.36 billion to $3.55 billion. Gross profit also increased year over year from rupees 9,693 crore up to rupees 10,221 crore.
So revenue and gross profit both up year over year. That sounds like a healthier trend on the surface.
It does, but while those top-line metrics improved, the EBIT margin still decreased year over year. It went from 17.1% in Q1 of FY25 down to 16.3% in Q1 of FY26.
Oh, okay.
And the profit after tax also decreased year over year from rupees 4,258 crore down to rupees 3,844 crore. So this means that while they grew the top line consistently year over year, the profitability didn't follow that same upward trend this quarter, which again reflects those ongoing investments we talked about.
Right, the investments. Now, when we talk about global companies like HCLTech, currency fluctuations can sometimes, muddy the waters. How does their revenue look in constant currency, which strips out those FX effects?
Yeah, that's a crucial point for a global IT services player, absolutely. Based on the recent Q1 results for HCLTech, the overall revenue in constant currency actually reported a sequential decline of 0.8% in Q1 FY26.
Okay, a decline there.
And interestingly, it also declined by 0.8% in Q4 FY25. So we've actually seen this trend for 2 consecutive quarters now in constant currency terms.
What about their different business segments? Were some more impacted than others on that constant currency basis?
Yes, the services business was almost flat in constant currency, just a minimal change of minus 0.10% in Q1 FY26.
Okay.
Their products revenue in constant currency, however, that declined more significantly, down by 7.1% in Q1 FY26.
Any specific reason given for that product's decline?
Yeah, the decline in products was partly attributed to seasonal weakness in HCL software.
Yeah.
Software products often see dips in certain quarters just due to typical purchasing cycles.
Gotcha. Okay. Stepping back from the pure numbers, where has HCLTech seen growth geographically and across different industries? Based on the recent Q1 results for HCLTech, what's the market picture look like?
Well, the market performance paints a bit of a mixed picture. Europe and the rest of the world experienced strong growth, which is positive. However, the key U.S. market was flat year over year.
Flat in the U.S., okay. And by industry, which sectors are driving their business and which ones are lagging a bit?
Right. The growth leaders were technology, telecom, financial services, and retail.
Okay.
On the weaker side, we saw manufacturing, public services, and life sciences. But the company's management specifically noted, and this is important, that they have seen discretionary demand return to the technology and financial services sectors.
That's an important sign. Client confidence may be returning there.
Potentially, yeah. It's a positive signal.
What's the outlook for these sectors going forward based on what HCLTech is expecting?
Well, the outlook for public services and telecom is seen as stable. But manufacturing, life sciences, and retail are expected to remain weak, at least for the near term.
Okay, so what does this all mean for their full-year outlook? Did these Q1 results impact their overall guidance for FY26 at all?
Yes, it did, slightly. Because of that decent revenue performance in Q1, HCLTech has actually increased the lower end of its full-year revenue growth guidance.
Oh.
The new guidance is 3 to 5% in constant currency for FY26. That's an increase from the previous 2 to 5% range.
So they tightened the range upwards.
Exactly. And the services revenue is expected to show similar growth. It suggests they are pretty confident in their top-line trajectory, despite these current pressures we've been discussing.
Right. Okay, let's get to the heart of that short-term pain we mentioned earlier, the margins. How significant was the deterioration, really, and what exactly drove it? This is often where those strategic choices become most evident.
Yeah, absolutely. Based on the recent Q1 results for HCLTech, HCLTech's overall margins clearly deteriorated in Q1 FY26 compared to the prior quarter, Q4 FY25. They fell from 17.9% down to 16.3%.
Oh.
And this wasn't uniform across segments either. Their IT and business services margin declined from 17.0% down to 15.1%. And products and platforms saw a drop from 24.3% down to 22.4%. So yeah, a noticeable dip across the board.
That's a clear dip. What were the main culprits identified for this, 160 basis points decline in the operating margin? That's a 1.6 percentage point drop.
Yeah, it was a decline that caught some attention, and the company attributed it to four main reasons. First, higher sales and marketing expenses, which had about a 30 basis points impact.
Okay.
Second, and this was the biggest factor, was lower utilization, causing an 80 basis points impact.
That's significant.
It is. It often means they're either redeploying talent for upskilling or maybe experiencing a lag between project completions and new project ramp-ups. Several factors were mentioned: building capabilities for specialized skills, a specific ramp down in their automobile business, a slower ramp up of one large deal, and some inability to quickly deploy resources freed up by productivity gains.
Okay, so a few things feeding into that utilization number.
Right. Third, there was a 30 basis points impact from a specific client's bankruptcy, which, that was a one-off event.
Unfortunate, but a one-off.
Exactly. And finally, a lower share of their better margin software business contributed another 20 basis points to the decline.
So it sounds like a confluence of factors, really.
Yeah.
Many of them sounding like strategic investments or adjustments rather than just operational missteps. What about their investments in AI specifically? Was that mentioned?
Absolutely. The company is actively investing in AI and its go-to-market strategy, and that's definitely part of those upfront costs impacting the margins right now. It's a calculated move, really, to position themselves for future growth in that area.
Okay. So what does this all mean for the margin outlook going forward then? Is this just a temporary hit, or should we expect this pressure to continue for a while?
Yeah, that brings up a critical question, right? These investments for the future could definitely put pressure on margins beyond just Q1 FY26.
Makes sense.
And as a result, HCLTech has proactively lowered its full-year margin guidance. It was 18 to 19%. Now it's 17 to 18%.
Okay, reflecting that investment period.
Precisely. The company expects margin normalization, sort of getting back to previous levels, maybe in FY27, or at the earliest, perhaps by the exit quarter of FY26. So yeah, it's a planned multi-quarter investment phase.
Okay, understood. Let's look at order inflows again, that key indicator of future business. How did Q1 FY26 actually perform in terms of securing new deals, and what does this tell us about what might be coming down the pipeline?
Right. Based on the recent Q1 results for HCLTech, the order inflows for Q1 FY26 were $1.8 billion. Now, while it was described as decent, it was, not strong when you compare it to previous quarters like Q4 FY25, which saw nearly $3 billion, $2.995 billion to be exact.
So why this softness in Q1? Is there maybe a concern about new client acquisition slowing down?
Well, the figure was significantly impacted by that spillover of orders we mentioned earlier.
All right.
There was one large vendor consolidation order from the financial services sector that HCLTech actually won, but it wasn't included in this quarter's order book figures.
Okay.
And additionally, there are two other large orders that are expected to spill over into the next quarter, Q2. So that should make the Q2 inflows look quite strong.
Okay, so again, more about timing than a fundamental lack of wins, it seems.
That seems to be the narrative, yeah. For investors, obviously, this kind of spillover can still create a bit of anxiety, but the company seems pretty confident these orders will land soon on the books.
That's encouraging for Q2 then. Now, connecting this to their growth strategy, how is HCL Tech managing its workforce overall? We heard about the focus on new age skills earlier, but what's the bigger picture with headcount?
Yeah, this really highlights their strategic shift towards efficiency. The overall year-over-year growth in headcount was only 1.7%.
Only 1.7%?
Yeah, which actually trailed their 5.4% year-over-year revenue growth quite significantly.
Interesting.
This indicates that the company is actively pursuing what they call nonlinear growth through automation. Essentially growing revenue faster than headcount by leveraging technology to boost productivity per employee.
So they're not just adding bodies, they're optimizing.
Exactly. That's the idea.
And specifically on acquiring new talent with these specialized skills. You mentioned higher compensation earlier.
Right. While the addition of new graduates was, decent, the company is placing a really strong focus on specialization. They are offering significantly higher compensation, like even 3x to 4x the base salary. For specialized elite skills to prepare for what they see as surging demand in the AI world.
So that's a very clear investment in future capability rather than just volume, building a sort of specialized strike force for the AI economy.
That's a good way to put it. Yeah, exactly.
Okay, finally, let's wrap up by considering HCL Tech's outlook from a broader investment perspective. Based on the recent Q1 results for HCLTech, what are the key risks people should be aware of, and what does the analysis suggest for the future?
Okay, so if we zoom out a bit to the bigger picture, a key risk to consider is always the potential for a severe curtailment in IT spending generally.
Right, the macro environment.
Exactly. This could happen due to a macroeconomic slowdown in developed countries, which is, always a background concern for these global tech firms.
Understood. Despite that risk, how has the stock performed recently?
Well, analysis indicates that the stock has actually experienced a decent run over the past 3 months or so, and it also offers a pre-tax dividend yield of nearly 3.7%, which is something investors often look at.
Okay. And what's the sort of short-term and long-term outlook for the stock's movement, especially with this short-term pain, long-term gain narrative we've been discussing?
Yeah, this brings up an important question for you, the listener, if you're thinking about the company's trajectory. From an investment perspective, the analysis seems to suggest that the stock might consolidate, kind of trade sideways in the near term.
Okay.
That would be influenced by the anticipated softer performance in FY26 because of those investments we've detailed.
Right.
However, for investors with a longer-term horizon, the analysis suggested considering maybe adding to their position during any correction or dip in the stock's price, really anticipating the potential long-term gain once these investments start paying off.
What an insightful deep dive into HCLTech's Q1 FY26 results. It really feels like we've seen a company making quite deliberate, strategic, future-focused investments. And they seem willing to take some of that immediate margin pressure for what they hope is long-term gain in this rapidly evolving AI landscape.
Indeed. I mean, the commitment to specialized skills, to automation, and actively investing in AI, it's a pretty clear signal of their intent to remain competitive amidst this huge transformation happening in the tech sector.
Yeah.
It really highlights that strategic challenge so many companies are facing right now. How do you balance immediate profitability with that crucial need to invest for what's coming next?
It's a tough balancing act. So what does this all mean for you, our listener?
Well, I think it's a powerful reminder that looking beyond just the headline numbers, the revenue beat, the margin miss, and really trying to understand the underlying strategy, especially in a dynamic sector like tech, it just provides a much clearer picture of a company's potential trajectory.
Absolutely. It definitely makes you wonder, how many other companies out there are making similar bets on the future right now, willing to take that short-term hit for potential long-term dominance?
It's a key question across the industry.
Well, thank you for joining us on this deep dive today.
Yes, we hope this analysis helps you connect the dots and provide some valuable insights.
Before we go, just a very important disclaimer. We are not SEBI-registered financial advisors. If you are considering making any investment decisions based on anything you've heard, please consult a certified financial advisor first.